I'm going to answer a question today which is a follow-up to my Ray Dalio video, and that's that when are interest rates likely to rise? Now, a better question maybe to ask is when are interest rates likely to rise by a substantial amount? In other words, I don't mean by 0.25% or 0.5%, but to a large extent, maybe to 2%, 4%, 5% or whatever. Now, I'm going to make an argument on this video, and that's that people who have been waiting since 2008 for interest rates to go back to say 3, 4, 5, 6%, they're going to be waiting a very long time more than likely, and there's some simple reasons for that. Now, Japan has had 0% interest rates for a long time because of the secular stagnation argument. Now, the secular stagnation argument, I'm not going to kind of go into detail about it, but basically the way that economists explain it, and I'm not an economist, right? But the lion's share of economists who have studied Japan and now the Eurozone are saying that in a lot of developed countries you have a problem, and that's that, well, you have almost debt deflation. Not in all advanced countries, but you're seeing in the Eurozone now, Japan, very little, if not deflation, for a long period of time, because you have declining populations, you have people who are not spending a lot of money, you also have lack of business investment, and the current crisis is largely going to make it worse probably, because if you think about it, what are people going to do now? Most people, they're either going to spend less and or they're going to make very safe investments, say for example in index funds, bond funds or whatever. But if you're a private business owner, unless you're a big business, a lot of people, even though there are some people who kind of recognize, well, this is a good time to invest in our own business, a lot of private business owners are being very conservative at the moment, right? I know a lot of people, especially in Europe and elsewhere, who are saying, oh, I did plan to expand my business, but now I'm just going to do more private investments. So things like private equity or indeed any kind of risky investments, which are often needed to get the economy growing, probably there's going to be less of that kind of thing, right? So we don't live in inflationary times. Added to that, you have oil, which is down. You have so many deflationary pressures. You have tech as well, because we're going towards a digital world from an analog world. And let's face it, your $5 or $10 a month Netflix subscription is cheaper than going to the cinema. So you have all of these kind of pushes towards deflation. And that means that even though there's some pulls towards inflation, like what the central banks have done, like localization of supply chains, inflation is not likely to be a big problem anyway for the foreseeable future. Yes, we might have a bit of an uptick in inflation, as I mentioned in a video a few times ago, right? But that's not likely to be out of control inflation, and governments need to get the economy moving. So that's another point, right? Even if inflation upticks a little bit, basically the economy isn't strong enough to allow for, say, 5% interest rates. Look at the United States. They had consistently good, or at least acceptable growth from 2009 until 2019. And what was the maximum interest rates were increased by? 2 to 2.5%. So they never went back to say 3 to 4% like they were in the 2000s, or indeed, well, they were 10% or so, weren't they, in the 80s and sometimes in the 70s. So I'm not going to predict where interest rates are going to go, merely that I think that at best they're likely to go to 2 or 3% in the next few years. If not, they could be at 0% for decades because of what's happening around the world. So, if people want to get more for their money, they're going to actually have to be in assets like markets, bonds to a certain extent, but bonds don't pay very much, but maybe a little bit of diversification there.